investors and business property owners are improving cash flow and finding immediate tax savings from their business properties through a tax strategy known as cost segregation. Whether you're a CPA, financial advisor, business owner, or commercial property owner, you need to know the basics of this tax technique. Even if you think you know what there is to know, let's get acquainted with the basics of how to explain cost segregation and cover some of the details of cost segregation benefits. Your clients or colleagues will be paying great attention to this when you explain to them how they can save millions of dollars in taxes using this technique. Well, first of all, what is cost segregation? Well, cost segregation, sometimes also referred to as cost segmentation, has been around for many years, and the IRS has been wrestling with this issue as far back as 1942. It's only been widely recognized and, more importantly, approved by the IRS in its current form since 1986. If you want all of the details of the history of cost segregation, be sure to click on the link below this video. In a nutshell, cost segregation provides the vehicle by which a property owner can accelerate the tax deductions available when writing off the cost of purchasing, building, or renovating commercial property. And the issue is basically how quickly should a taxpayer be allowed to accelerate the depreciation of their assets. The faster assets can be depreciated, the faster a taxpayer can benefit from the expense deduction against income. And the longer it takes to depreciate that asset, the better the IRS does in pushing that deduction into the future. And that's been a timeless battle between the Treasury and the taxpayer. Well, let's start with a quick example. Let's say Acme Corporation buys a corporate office complex for use in their business and pays $39 million for the property. This expenditure is a business expense and should reduce income subject to taxation, right? Well, under older accounting methods, Acme would be forced to write off the expense of that entire purchase over 39 or even 40 years unless components of the building could be identified as having a shorter recovery period, which was a confusing process involving many different IRS regulations. If Acme wrote the entire building off over 39 years, they would be able to deduct $1 million of the expense each year, but it would take 39 years to write it all off, and that's a long time to wait. When you buy a printer or an office chair, you simply write the expense off in year one, and you pay less taxes that year because of it. And that means you have more money in your pocket right now. So why should you have to wait 39 years to expense the purchase of your building? Well, for starters, real property has value for a much longer time. In other words, it depreciates or loses value more slowly than personal property. So when your printer is in the dumpster, there's a good chance that your building will still be standing for many years to come. As a result, the IRS has determined that the depreciable life of real property is generally 39 years, and for residential commercial property, that life's about 27.5 years. The problem with the IRS's old approach was that a good percentage of that building that Acme bought or built is not going to last 39 years, and attempting to justify what parts should be expensed sooner was a really complicated process. A lot of what's in that building, such as carpeting, cabinetry, and accent lighting, is obviously personal property, even though it may be attached to or part of the building. For that property, it just doesn't seem fair to force the taxpayer to expense the cost of it long after it's become useless, broken, or been replaced. So what to do? Well, thankfully, after a little bit of conflict and litigation, the IRS modified the way they handle the depreciation issue. Current IRS treatment of real property now allows the taxpayer to treat different parts of that property differently. Through the IRS Cost Segregation Audit Techniques Guide, the IRS now lets a taxpayer categorize property in a predictable manner, allocating some property that has a shorter life to 5-year property, such as carpeting, accent lighting, and more. Some of it is 15-year property, like exterior paving and land improvements, and the balance of it as 39-year property, such as structural elements and most electrical and plumbing. There's also a 3- and 7-year property, but that's another topic altogether. Well, the new system is referred to as the Modified Accelerated Cost Recovery System, or MACRS. And the methods of determining what life an asset should have under the system, while still complicated for the tax person and even many CPAs, it makes for some big tax savings for the property owner if it's done properly and by a qualified engineer. So is it worth all the trouble to do a cost segregation? Well, in the example above, let's assume that Acme Corp's building actually costs $10 million instead of $39. By segregating the assets through a cost segregation study, they could potentially allocate 13% of their building to 5-year property and 17% of it to 15-year property. And that means that instead of $10 million being expensed over 39 years, Acme could write off $1.3 million, or 13% of that expense, in the first 5 years, and $1.7 million of it in the first 15 years, thereby accelerating $3 million. Assuming that Acme pays taxes at a rate of 40%, their ability to write off those expenses reduces their tax liability by hundreds of thousands of dollars in the first year alone and nearly $2 million in the first 5 years of the acceleration. The reaction that some have to this math is, well, I would have been able to write that off eventually anyway. But that ignores the net present value of money issue. Assuming a net present value of money of just 5%, the value of this shift, when taking the deductions earlier, is worth hundreds of thousands of dollars in real cash value immediately when compared to simply taking the expense of the building over 39 years. So what does it cost to do a cost segregation properly? Well, in order to obtain the benefits described above and do so without negative IRS scrutiny, the best practice is to perform a cost segregation from an engineering approach. This does cost several $1,000s more than simply having an appraisal company or CPA perform an appraisal or residual cost segregation, but there are several benefits to the engineering approach that more than justify the cost. First, the amount of property that can be classified as short life is substantially higher. Secondly, the resulting report provides a segregation of the assets regarded favorably by the IRS because it breaks out all assets of the property to their lives on a component-by-component basis. This demonstrates to the IRS that the study did not improperly weight the value of the short life assets in an effort to skew the allocation to shorter lives. Finally, because 39-year property is broken out in detail, this method of reporting also provides a great baseline of the cost of all of the assets in the case of future abandonment that you can do when renovations are made to the property. For many years, cost segregation was a process that was both confusing and expensive, resulting in underuse as a tax savings technique. If you or a client have a commercial property that was acquired or built less than 10 years ago and has not been the subject of a full and proper engineering-based cost segregation, there may be a great deal of cash sitting in your depreciation schedules. Taxpayers can also catch up on the depreciation that should have been taken in previous years, and this is known as the Section 481 catch-up adjustment. This allows catch-up adjustments from previous years to be claimed entirely in the first year right now, whereas previous rulings had required taxpayers to spread that catch-up over a 4-year period. And that means that properties where several years have already passed since acquisition can actually pose a larger benefit in the current tax year because all of the past years of accelerated expense that were not taken already can be caught up in the year that the catch-up adjustment is filed. And that's great news if you're a property owner or a CPA who has passed up on this opportunity previously due to cost or the confusion that the IRS had created in the application of the rules. It is worth noting, however, that the optimal time for a cost segregation in terms of ensuring accuracy and maximum benefit from a study is in or near the year that the building and/or building improvements are placed in service. This allows for a thorough examination of contemporaneous documentation and maximizes the tax-deferred benefits from this analysis. When considering this highly technical and specialized tax offering, you're advised to directly consult subject matter specialists, that is, both accountants and engineers that are well trained in this area of the tax law. Also, be sure to act in good faith in trying to ascertain your client's tax return filing position and achieve a more likely than not filing position or higher, as many of these claims are frequently audited by the service.